All right. We will experiment again with audio. Hold on. Now we go to the audio. See, it tells me everything's fine. I get all these green check marks. You get green check marks, it's supposed to be working. That's the way it works, or at least the way it's supposed to work. Okay, so we are going to cover wage price spirals, and we may even talk about labor hoarding. You're like, I don't give a crap about those things. Well, you should, because it's probably the beginning of the end for the labor hoarding cycle, and people going to start getting laid off. And all that means is less eyeballs looking at crypto for investment. It's less eyeballs looking at anything for investment. But it actually means more opportunity for those of you that buy these low times in the market. Yeah. So we'll talk about that. We will, of course, we're going to cover our AI news. We're going to do a quick look at markets, and then we'll go into AI news. If you have any cool questions, any badass questions that should arise, feel free. And then let me go through the list really quick, because since this is the public facing one, we can do all of the hellos and good mornings. Okay, so let's go here. Conan, Michael, Alex, Ardlin, Jen, Deborah, Richard, Joseph, Kathy, Paula, Andy, Thomas, Cisco. I like how he's yelling it. I made so much money. You get rich, Cisco. L. Paul, P. Kelly, Jerry, Top Short. And also, you didn't make money with me. You made money with you. You just happen to be listening to a couple of my random rants, and some of it may have resonated. But everybody's on their own kind of personal portfolio journey. I don't take credit for any of this stuff. Hey, man, they pay me. You don't owe me anything. They pay me, and you pay them. Therefore, you don't owe me anything. Crypto Amigos, Eric, Greg, Michael. Yes, hopefully we've tackled the bad sound thing. Yeah, I know it was scratchy. Paula. And let me get to new ones. Michael. Talents. And I'm going to say some of these over and over because I don't know who's. But Big Kitty, Amy, John, Deborah, Richard. Yeah, we're doing a lot of these over and over. Hold on. Let me get to the new ones. That's the only thing. They haven't sorted chat quite yet. Chat's not been completely figured out, but they're getting close. Joseph, Frank, Kathy, Dubai Money, Greg, Steve, Tom. No one just likes caps. You're yelling, Cisco, and it's okay. Yell. You yell. Get your yell on. Yeller's going to yell. Tim, Lanny, Thomas, Dana, Sean. Done. Whew. We nailed it. Anybody here play Pop 1? Any Pop 1 players? Y'all ain't about that. Y'all ain't about that Pop 1. Tim, what's up? Okay, so let's do this. Let's go to markets first. You'll know this one is a little bit different. This is a little bit more kind of wide scope. When we do our digital heavyweights, it's really more about kind of specific investing principles and tactics, game theory, cognitive bias, and more kind of relevant decision making. This is a little bit wider scope. Yeah. So, yeah. All right. Audrey. Hello. Okay, cool. So let's go. Let's do some. Oh, real quick, because I had an email. When you see where it scrolls by and it says, a little scrolling thing. I used to put prices there, but that's stupid. It doesn't make any sense. We have prices right there on the screen. And it will say 230 to 231 days to green. What that means is we've been tracking this for a few hundred days. This means that statistically, based on the cycles in the crypto space, the big, sloppy, wide spectrum moves in markets, not the little day-to-day BS that TA people think that they can trade on, which they don't. They end up losing all their money. But the wide swaths of, total market cap in and out of the crypto space, meaning money coming in, money going out. This is the aggregate time when looking back over the very short duration of time that the crypto space has been around. Remember, it's only been around since, 2009 and not as a tradable market until really later than that by about a year. I mean, really by about 4 years. It wasn't 14 or 15 before you could really trade these markets. There were some people, but, exchanges had very few assets. Even Coinbase had 4 things, right? It was like Bitcoin, Ethereum, Litecoin, which is that garbage project from Charlie Lee, who's such a piece of garbage, that guy, who basically sold at the top and then told everyone, oh, I don't want to have perverse incentives to be involved in the project and all this kind of what a piece of crap. And he was telling everybody, not to get off on a Charlie Lee tangent, the guy is a piece of garbage. He sold at the top and then lied about it for a few days, got caught, then had to kind of own up to it. He's just such a douchebag. Anyway, whatever. Bitcoin, Ethereum, Litecoin, Bitcoin Cash, because that was after the ABC thing where Bitcoin split to Bitcoin Cash, and you had Bitcoin Jesus, who decided to go all in on Bitcoin Cash, and I think he has summarily lost most of all of his money, which is kind of depressing because you kind of wanted to pull for that guy. Anyway, it is what it is. But many of you are later to the markets than 2014, 2016, 2017, and you really don't give a crap about that. You're like, how can I make the most money? Well, you look at these cycles, and they do tend to kind of correspond with tech investment to a degree. And again, this is a new market. It's illiquid assets on illiquid exchanges traded by sketchy individuals, but it does seem to kind of track with tech investment in the macro. And the macro is important, especially as we go into we're in a recession. At least the Europeans will admit that. We just won't. because of a bunch of prideful economists and politicians that can't admit that they have no idea what they're looking at. That's really what it is. They can't admit to everyone, we have no clue what we're looking at. We have no clue what to do. Raising rates is not really tightening. Lowering rates is not really easing. Matter of fact, it could be the exact opposite of that. There's some theory and some kind of napkin math that would show the opposite. Quantitative, QE, quantitative easing, and then the QQE of Japan, and then the versions of that they've done in China have never, ever worked, not even a little bit, and they are perversely wrong. There's nothing quantitative. Like when you take any math in your life, is the answer to solving it go up by 1/4, go up by 1/2, or go up by 0.75, and then do that each month, and then skip 1 month, and then go down by 1/2 or 1/4? Or does your whole entire life function on quarters, on 25 basis point moves? That's quantitative, right? There's a huge problem in the economy. Therefore, 0.25 is the answer. But 0.25 is the answer last year, sir. Yes, and it's the answer now. But so all of your math, every math equation they do at the Fed equals 0.25 degrees of 0.25 increments, intervals of 1/4 point. That's all the math that ever happens at the Fed. It ends in, thank God, everything ends in quarters. God, it makes life easy, doesn't it? You almost think all you'd really need is a Phillips curve, some very loose, weak, and, let's face it, fake unemployment numbers and employment numbers, which you can just swap back and forth. No one knows what the F you're talking about anyway. And you can just say, well, I don't like the 40, I don't like the 40 number, the 40 week number. Let's just take the 4 week and the 6 week number. Oh yeah, that's cool. Hey, you know what? Let's go ahead and give the public a bogus number. We'll pump it out to all the idiots over at CNBC that they don't know what they're looking at either, and they just parrot out anything we say. So we'll use the compliant media to pump out a bullshit number. Then we will downward revise that number. Or if it's unemployment, we will upward revise it, or we'll just fake it. And we'll just aggregate those revisions, 6 months, 8 months later. It doesn't matter that people reacted based on that number, but in that original number was fake. But don't worry, we got the tools. We have the tools to fix this. We will use a very incredibly math-driven process called quantitative easing. Quantitative. I feel like quantitative means there's some math involved. Nope, no math, sir. You have only 4 answers. At the Fed, here's how it works. They have 4 levers. One is 0, one is 0.25, one is 0.5. That one barely gets used. One is 0.75. Those are the levers. Those are the only levers. You can go up with it. You can go down with it. And thank God that all quantitative math, because if you know any physicists, particle physicists, astrophysicists, mathematicians, deans of research, people that study math, just math in general, they always, every single answer to any complex equation is either 0, 0.25, 0.5, or 0.75. You guys know that, right? Congratulations. You're all ready to work in the money business. God, it's so stupid. It's so effing stupid. You try to explain, and people are just like, what? What are you talking about? All they do is they're bankers. They study the economy. They don't study shit. The Fed has a lot of really brilliant people that work for them, and they don't listen to them. These people put out papers, and the Fed ignores all of this, and they have their levers, and that's it. So it's like, it's so stupid. And yet, and this is the unfortunate caveat to all of that rant, is that 99% of the dummy public, and that's the compliant media included, CNBC and all the douchebags over there, and all the jawboning garbage on Fox and CNN, CNBC, MSNBC, all of the acronyms of garbage, they're even worse. And they're just parrots reading off of a freaking teleprompter. You could put on there like, I am a complete moron. I'm just basically what like Jim Cramer rants, right? Jim Cramer rants. So like 90, everybody you're investing against, everybody's not fair. The majority of the people that you're investing against are dummies, meaning you have a huge opportunity if you can dig into a market where you feel like the world is going to end up at. Does that make sense? So that's the whole point. So with that as a backdrop, there's a lot of opportunity in and around the digital asset space. And that's what we will plumb. Let's take a look at markets for a little bit. Okay, what's going on in these here markets right here? Bitcoin up just a hair, pretty flat, up on the year still, but it was up, from a very bad year ago. Ethereum very flat. XRP down 2%, but still flat. This has been kind of holding around that 45 to 50 cent area. They're waiting for a settlement. Whatever, doesn't matter. Cardano, quiet. They did an upgrade to the Lace wallet, Lace 1.2. They've done some node upgrades to make the stake pool operators operations more efficient. You can dig into that if you want. It's pretty cool. Cardano just keeps pumping out code. And no one let's face it, no one cares when the market is quiet, but you should be investing. understanding that the people that you're investing against are mostly stupid. It's true. All right. Dogecoin, no one cares. Matic, interesting, quiet. 60 cents. Hard to say. Hard to say if I would lean into it right here. I don't know. I think you need exposure in layer twos. Your other one would be optimism. Your other one would be one. Although one is it's a lottery ticket. So proceed with caution. Let's keep going. Polkadot, no. Monero, no. Cosmos, yes. And again, my yeses and nos is just for me. You do whatever the hell you want. I don't really care. I have a McLaren. All right. Filecoin is a yes for me. Data is important. Near is a near fail. Cool tech, terrible company. I mean, at a certain point, the company needs to take responsibility for having no communication strategy and marketing. If you don't market your thing, you're just somebody with some piece of software in the desert. No one cares. It's the same problem with Algorand. I don't care that everyone there is smarter than me. You're not that smart. If you were smart, you talk to people. You don't feel like you need to talk to people, then you're an arrogant POS, and I got nothing for you. Are they going to make a comeback? Hopefully. Is it going to be to $3? I'm dubious that's a possibility at this point. Is $1 a possibility? I think so, but who knows? Graph token is a yes, but only because it's pushed out by spammy douchebags. And I say that because most of the people that are interested in Graph have no interest in Graph. They've just heard, these douchebag gurus and pump and dumpers and service sellers tell you to buy it. They don't know what it does. They don't care what it does. They just see that it's cheap and it's likely to go up. The Tikas of the world. VeChain is a play on China. Boy, you can't get it much wronger. It's at $0.015. So the risk reward skew is probably a good lottery ticket, but proceed carefully. Is China going to ease? Are they going to get the world out of the depths of this recession? Well, they may do their version of easing, which is kind of manipulating rates internally. I don't think it's going to make any difference. Hasn't made any difference before. I don't think it'll make any difference this time. Their problems are structural in nature. It turns out that all the problems that the world had in 2018 and 2019, they didn't just disappear during COVID with a couple of checks and stimmies passed out. Turns out those problems are still problems. Like if you had a heart problem in 2018 and 2019, and they gave you medicine to cope with the pain for 2020, 2021, 2022. We're in 2023. The medicine wears off. You still have the heart problem, bro. Don't go jogging. Render, it's sentimenty, pumpy, kind of a cool idea. It's kind of a lesser, half-assier, more Hollywoody attempt at distributed compute. It's too narrow in focus, in my opinion. And although it has some cool Hollywood names, they're not technical names. The team is not so great. By scoring it by the 5 T's, I'm not super fan of it. But it's a sentimenty, pumpy, Chamath disruptor. It's a huge disruptor. So they pump it all the time. So it probably wobbles from, say 55, 75 cents up to a couple of bucks. I don't know. I mean, obviously in an expansionary, bullish, big market, everything does well. But beyond that, I don't think there's a lot of future for Render. Float, no. Ocean, yes. Zcash, no. AGIX, yes. Remember, there are still rewards coming for Singularity Net in the form of, if you own Singularity Net, there will be some reward process, meaning for Rejuve, for Cogito, for Sophia Verse that's coming, and for Hypercycle, there will be some rewards distributed to the community. Now, what that looks like right now, this second, no one knows. So don't send me 75 emails saying, hey, what do I have to do? You don't have to do nothing. Right now, 0. You do exactly what the Fed does, 0. That's all you have to do is sit back and do nothing. They will announce these things and they'll give everybody plenty of time. If you want to know kind of up to date, join Digital Heavyweights, bro. All right. And then you'll know like before it happens. What? Optimism, I am optimistic about. I like their deal with Coinbase. For those of you that are talking Coinbase, Coinbase is crap. Coinbase is going to be doing custody for BlackRock's spot ETF, which my guess is miraculously they'll have worded it just right for the SEC to approve it. No one else could get it right, but my guess is BlackRock has figured it out because they're that good, right? Because it's a level playing field. All you have to do is write. See, and the way this works, for those of you that don't know, when you submit a rule change, what happens is that the SEC will go, they'll either rule against it or they won't say anything. If they don't say anything, the rule change goes through and it would allow a spot delivered Bitcoin ETF. That gets into a whole other thing about financialization of assets and all that. We won't go down that path, but just understand that. So they submit a rule change which would allow this ETF to list. If the SEC strikes down the rule change, they can't list the asset, right? So the Bitcoin spot Bitcoin ETF has been tried, I don't know, 17, 20, 25 times, about as many times as quantitative easing has been attempted. And in the case of Bitcoin, it's as effective. None of these have passed muster. The Winklevi submitted, I don't know, 3 or 4 of these things. They all got shot down, probably because those guys are dummies. Grayscale has put forth 1 or 2 versions. They all got shot down. They're in court now. They're suing the SEC. I mean, everybody's put forth one. But interestingly, you had, a spot Bitcoin ETF would be huge. Yes, a spot settled. Right now, it's cash settled. And so you'd say, well, why is that bad? Well, it's not bad. It's just not that interesting because that means that all of the business can take place without actually trading Bitcoin. It's a market against Bitcoin where you need no Bitcoin. A spot settled would be like a physical delivery market in gold. Like in the gold market, if I sell a futures contract on 100 ounces of gold, because they're in 100 ounce, you guys probably know that, I have to deliver that 100 ounces, right? So to somebody, physical delivery, right? If I buy one, I take physical delivery or I flip the contract. So the idea of physical spot is a big deal because it means the asset would then be traded. The asset would be warehoused. The asset would be moved. Well, the BlackRock ETF filing has Coinbase as their custody solution. Okay, Fidelity is also jumping on. They have they're filing one too, which I'm guessing is a copy and paste of the BlackRock submission with their own custody solution. So isn't it funny when the whole world's talking crypto? Oh, it's terrible. It's terrible. It can't be that terrible if BlackRock, the scummiest demigod that we know, the high priest of evil, wants to be in on it. It can't be that, awful. So, don't listen to the noise. Try to dial down the noise. So anyway, I like Optimism's connection to Coinbase. I know that's a weird derivative kind of shoestringy, follow the breadcrumbs type thing. But anyway, that's me. I also think Optimism is better tech than, from what I've read, better tech than Polygon. Anyway, all right. Arweave is a yes. Fetch is it's a maybe. I would go see yesterday's Digital Heavyweights. We broke down a lot of these as far as like investable, non-investable, things like that. In the AI assets, we are Fetch, one of them. So Fetch, Numeraire, Singularity, Rejuve, Nunet, Hypercycle, Cogito, and what's coming is Sophiaverse. Okay, Cogito it's a no. It's an absolute no. Stay away from it. Light it on fire. Don't get anywhere near it. And I'm not telling you what the prices may do. I'm just telling you what my gut feeling is. And I'm a home teamer. I'm in Cogito. I'm one of the early investors in Cogito. But the team right now, as it stands, is not investable. You cannot invest in this token because you can't invest in this team. So that's off the list. NewNet is a yes for me. Hypercycle, yes for me. Rejuve, it's getting close to the original token listing price, meaning I am converting my rewards from these other assets that I earned at Singularity DAO. I'm converting the rewards to Rejuve just because Rejuve has finally come down from that obnoxiously ridiculous 14 cents. And it's sustained, it's sustained for a couple of weeks, 7, 8, 10 cents. And then it came right down. Why? Because if you ask yourself, why does the token exist? There's no good answer. There is no good answer. It doesn't make sense. So right now they have to answer that question. I love the idea of longevity and AI-based longevity and biology mapping and all these cool things. I want to live longer, healthier, happier, all that. But right now, Rejuve is not likely to make that happen. So cool team, no problem with the team. Timing, maybe. Timing's okay. Tokenomics is okay. Not a ton of tokens. The Y token's not answered. There's no real reason to own this token. So if you're going to own it, it's a huge lottery ticket. It's an AI lottery ticket. We're in the year of AI, so that makes sense. I would just be very careful. This is not investable with new money. This is not investable at all. Now, I say that if there's some boom in AI and these all go up, don't be like, Nick said don't buy it. No, Nick said Nick's not buying it. That's what Nick said. Nick said Nick is not buying it. You do you. I'm just telling you my gut. All right. No. BlackRock is a spot settled. That's the whole point. There are already cash settled ETFs for Bitcoin. There's several of them. They're just not all that interesting. It's just a nebulous synthetic market that's not attached to the underlying asset, and that's the problem. So it is significant. Why it's another reason, Joseph, that it's significant is because everyone else has tried, and the SEC has really done a lot of sidewards, like crawling backwards. What they've done everything they can to, like borderline illegal, borderline, not illegal, but like right skirting the edge of legal as far as these denials. And now they're starting to get challenged. They're starting to get sued. And I don't know. My guess is BlackRock has figured it out. I'm sure they'll word it just right. Oh, God. Yeah, if only we were mice, right, John? Then we mice make it. What? Kathy. No, not Kathy. God, not Kathy. Kathy's, she lights money on fire. Be very careful. Kathy real good at lighting other people's money on fire. All right. Let's switch gears. We need to get in our brain space a little bit. We need to talk, the AI news, not super exciting today. Just a quick, DeepMind's new AI agents, very good at video games. That's cool, I guess. AI stock boosts the world's richest by 150 billion. Guess what? We all got poorer. The super rich got richer. Why? Because they're investing in AI. Cool. Okay, I say that. I didn't do so bad during the AI boom. I've done okay. And then Google, this is the best part of all this, I think, in all of the AI news that I was reading, or at least what I found the funniest, is that Google warns employees against using Bard. Google's like, don't use our AI. It sucks so bad. Well, that's not how they worded it. But anyway, Google's advised its employees not to share confidential information with chatbots like OpenAI's ChatGPT or their own Google Bard over fears of data leaks. Alphabet's concerned that human reviewers may review chat entries. Amazon and Apple have issued similar directives to their employees. Be careful what you share. Well, it makes sense, right? Samsung confirmed that its own internal data was leaked after staff used ChatGPT. Interestingly, Alphabet and other tech giants continue to rapidly develop chatbots using data collected from users. So they can do it. Listen. So here's the two stages of this argument. One, I'm Google. I can take all of your shit and I can use it, monetize it, make money off of it. I can sell it back to you. I can take your data, put it in a churn. I can make it into something that looks like butter and I can sell you that to put on your toast. Your data I took for free, sold it back to you, dummy. However, if you work here, please do not share with the AI systems because they may churn out the data and sell it back to other people. And we don't get a piece of that. If we don't get a piece of it, that's bullcrap. We're the ones that take free stuff and make money off of it, not other people. I guess that's the argument. So, okay, cool. Thanks. There's more to it than that. I mean, data privacy is important, although it has never been. I think it's funny that data privacy is important. Why? It's never been important before. You guys have never look, Google. Let's call a spade a spade. Google, whatever the hell is left at Yahoo, is Yahoo even a thing? They were using Bing for all their search, so definitely using Bing now. Yahoo doesn't even power their own search. So let's forget about Yahoo. Google, Meta, formerly Facebook. I mean, Microsoft, like they've been monetizing free stuff. They've been scraping our data, our human data resource, that resource for free forever. And you say, well, if you can't, I get it, the bumper sticker. If you can't tell what the product is, then you're the product. Cool. I just like to be told that I'm the product is all. I just want to know that. I just want to know when I'm the product. Hey, your data is being used to be monetized and we're monetizing it. Okay, cool. That's what you do for this free service. Great. Then quit showing me effing ads every 13 seconds on YouTube. I don't want to watch ads. I want to watch my YouTube video. Oh, we don't do that for the deal because shut up. You're scraping my behavior. You're selling my behavior to advertisers, and then you're forcing me to watch these ads. F you, bro. Anyway, baby rant. Okay, let's spend just a few seconds, a couple of minutos. Give me 3 minutes to tell you about the wage price spiral. I think it's important. It's something that you should keep in the back of your mind because it does kind of have to do with this labor hoarding.
Yeah, well, that's just like your opinion, man.
Okay, so we have heard it many times. You've heard this. They'll just, like Steve Leisman and these other douchebags on CNBC. Oh, well, it's a wage price spiral. What does that mean, Steve? I don't know. I just want to eat another hamburger, make my jaw look even bigger. Is there anyone more in need of a wig than Steve Leisman? Dear God, man. Anyway, what is the wage price spiral? So let's explore it is a pretty important concept known as the wage. Just listen, wage. Okay, you got it? Word number 1, wage. Word number 2, price. Word number 3, spiral. And where does labor hoarding come in? So this economic concept known as the wage price spiral is a term used to describe a situation where wages and prices in an economy continuously rise in a cycle and they feed into each other and they create a loop of increasing costs and prices. And a lot of time, there's no underlying there's not any perpetual monetary influx. For instance, you can have a little bit of money send a spiral into a spiral. You've heard downward spiral, right? And then you can turn the money off and the psychology of the spiral perpetuates the spiral. So let me break it down into steps. Step 1, you have wage increases, right? We saw this when we had this kind of weird, fake, faux competitive environment in the middle to late 2021. So the first step in the wage price spiral begins with an increase in wages. Okay, you get that. We'll pay you more, competitive, great. Workers then demand higher wages. Hey, give me more, either due to stronger bargaining power, inflationary pressures, even if they're even it's really price pressures, because inflationary pressures, at least recently, we haven't seen. We have seen price pressures, again, a few years ago, but they weren't really inflationary because they were non-monetary in nature. There was remember the phenomenon, right? The always and everywhere, phenomenon of inflation needs a monetary component to it. You need an input of money, and it has to be continuous. It's not a one-time shot. It has to be continuous, right? So anyway, that input of money has to keep happening. So if you do have price pressures, employers may agree to raise prices. They also may agree to pay to retain skilled workforce. Remember, think of all the money that you spend as an employer to go through the hiring phase, the interviews, all the people that you've hired to hire other people, and all the money it costs for then training those employees. I mean, it's a lot. Each employee, it's like around $10,000 like on the average to hire somebody before you start training them. It's like at least 10 grand that the company's just coughed up. So they're already in the hole 10K just getting you hired. Then they got to train you. Then you're going to have limited performance for a while because you're not up to speed. Then you get up to speed, you want to get a raise. It's like, dear God, man. Anyway, so due to stronger bargaining power, price pressures, whatever, employees agree to raise pay. Employers agree to raise pay to retain their skilled workforce or to prevent people quitting or strikes, right? Higher wages mean that workers have more money to spend on goods and services. Make sense? Okay, great. Step 2, increased consumer demand. So with higher wages in their pockets, Johnny employee, Johnny worker has more purchasing power. So this leads to an increased consumer demand for goods and services, at least in the near term. So when demand rises, businesses respond by increasing prices to maximize their profits. On one side of the table, the hiring and the employment side, companies are very slow to admit price increases and inflationary pressures. On the shrinkflation side, where they go, oh, we should put less Doritos in each bag, they're pretty quick. They seem to do that, right? I mean, Frito-Lay will go from 4 Doritos to 3 Doritos per bag in a flash, right? So shrinkflation, very much present. Anyway, so as demand rises, businesses respond mostly by increasing prices. They want to maximize their profits. They want to take advantage of the situation. It is what it is. It's a company, right? And if you own stock in that company, you would hope that they do that, right? Because what's the number one job of a company that you own shares in? Maximum shareholder value, right? Even if that skirts the edges of the law and morality. Okay. Step number 3, rising production costs. Okay, so as businesses face higher demand, right, like their input costs go up, they have to produce more goods, provide more services, and to meet this demand, they may need to hire additional workers, right? They have to invest in equipment, they have to purchase raw materials, and if there's some quagmires at the ports and the shipping containers cost more, and then the raw materials, the input costs, they pay a higher price. Therefore, they increase to overall production costs for the business. So now the business is paying more for the same stuff that they're selling to you at whatever is the current market price. The next step number 4 for you home gamers, is the increased costs that are passed on to consumers. So to cover, isn't it funny? Prices go up, they hire more, they raise prices. The input costs go up, they raise prices. They reduce the amount of Doritos per bag. Shrinkflation. Hey, man, sorry. We're just passing the savings. Do you guys remember when Exxon was testifying in Congress and some senator was like asking the head of Exxon, if you're just passing the price difference on, if that's all you're doing is passing, it's a pass-through cost, right? Like it costs us 4 more cents, we charge you 4 more cents. Then how is it that this year, in the last few years, Exxon turned out record profits? And then you saw a lawyer's hand rocket from out of the scene in front of the mic. It was like, I'm not sure what you mean. You know what I mean? You dick, you know what I mean. Anyway, God, these guys, especially the oil guys, right? Funny, whatever. Anyway, I'm not going to get on an oil tangent, but that's the whole thing, man. Anyway, so you get it, right? So increased costs are passed on to consumers. They're just doing what they can, man. Just doing what they can. So to cover the rising production costs and maintain profitability, businesses pass these costs on to consumers by raising prices. When the businesses raise prices, the costs of those goods and services increase for me and you, for you know, Bob, for Alice, for Charlie. This means that workers now need even higher wages to maintain their purchasing power, their standard of living, right? Hey, I just gotta make ends meet. Well, things cost more, therefore you got to pay me more so that things can. Step 5, repeat the cycle. So as wages increase due to rising prices, the cycle tends to repeat. Workers demand higher wages, compensate for an increased cost of living. Businesses respond by raising prices to cover the rising costs. This continuous loop creates a spiral effect where wages and prices continue to escalate. This can go in 2 directions. Anyway, so the spiral can have positive, obviously, and negative consequences. A near-term positive consequence is that employers pay their employees more, and that's kind of nice, right? On the positive side, higher wages improve the standard of living for workers and stimulate economic growth in those areas around those companies. But on the aggregate, it stimulates economic growth by increasing consumer spending. However, on the negative side, it can start to lead to inflation as prices rise faster than productivity, eroding the purchasing power of those wages. Moreover, if the spiral continues unchecked, it can create an unstable economic environment like the early universe until it dropped below a certain amount of like particle density and power. And then it makes it difficult for policymakers to have any idea what's going on. 1, they can't control inflation anyway. And 2, they don't even know what's going on. So you just have a lot of these factors. But now we get to a point where this has been kind of the I guess in summary, this has been the concept. This wage price spiral is a concept. It illustrates this interplay between wages and prices in an economy. It shows that if you increase wages, it can lead to higher consumer demand, which can lead to rising production costs, which can increase prices. This can have big implications for individuals in the overall health of the economy. Now imagine you go through a phase like this, like we just did, and now you say, okay, I'm a company, I'm looking at the environment, it doesn't look good, the world is going into recession, China is a chaos, all this stuff, the macro looks real bad, and not just because of all the reasons like subsidizing crappy companies and illegal behavior and all this kind of stuff, but like the cycle is tightening and we've reached the edges of credit and intermediaries like banks are stepping back and they're not making loans and they're not being intermediaries. They're not handling that intermediary function. And when they step back and credit tightens and cash and credit availability are less and there's no free flowing cash and entrepreneurs can't get loans, and you can't even service loans, there's buildings in downtown LA that are selling for less than the debt owed on the building. Buildings like skyscrapers. They're selling them for less than the price of the debt. If you unpack that in your mind, it should make you go, well, there may be a problem in commercial real estate. So this is this net tightening, right? So if someone's telling you inflation, they're just dumb. They're just dumb. Doesn't mean they can't be enlightened, but it means right now I would tune down the dial on that noise. And so as this all shrinks, you have a situation where companies usually like a lot of people are like, well, where are all the layoffs? If these companies are having to go the reverse direction of this wage spiral, where are the layoffs? There is all this embedded cost in having hired and trained and maintained these employees. and companies are waiting until the bitter end to start letting people go. You're starting to see it. You really saw it very quickly. We did a show where we looked at the companies that are doing layoffs, and you look at Amazon, and they're just chopping heads off over at Amazon. You work for Amazon, well, I wish you the best of luck. You're most likely going to be unemployed. So I think it's important to think about these broader concepts and how there's a lot of interplay and interconnectedness in these behaviors. And so when you see a switch flipped in the economy, it's not enough to have a drastic effect. You have so many diverse and weird, at least weird sounding inputs. And until you sit back a bit, like expand your mind a little bit and think about how the interplay between all these factors, between wages and input prices and the cost of goods and shrinkflation and labor hoarding, this idea that companies will hold on to the very last minute and then they still don't want to fire. So what they'll do is they'll just reduce the hours worked. They'll just reduce, which guess what? That's what's happening. Like, so it's very obvious if you step back what's going on. If all you use is a Phillips curve, you're not going to get it. It's not enough to cherry pick inflationary data points and ignore the other 900,000 very obvious pieces of information. Three is not enough. Divide 3 into like 89,000. You just don't get a big enough number to influence decision-making. Anyway, think about the macro. Don't just get, so myopic and narrow focus that you only look at crypto and things like that. You need to look at the bigger markets. A good digital asset investor, a good AI investor is thinking 15 to 18 months ahead, but has a good perspective, a good macro framework. And you will be much more competent, I think, than your peers. And that should be your goal, right? Be more competent than your peers. And at the end of the day, you're really only competing with yourself. Your balance sheet is all that you're competing with. It doesn't matter what the dude down the street or over here, over there, like, who cares? Who cares? You do you. You look at your balance sheet, it's X. You just want to make sure that 15 months from now, you've taken X to X plus some integer, right? Or if you're really killing it, X times some integer. A 1X, a 2X, a 3X, a 6X, a 10X. We need X to be higher. And in order to get X higher, in order to increase your balance sheet, to outperform debasement of currencies, things like that, to stay ahead of the game, you just have to think 15 to 18 months ahead, and you have to have some understanding of how the gears in the financial system turn, how the gears in the watch turn. So please endeavor to do that. Have a great day. Stay in school. Don't do drugs. Don't do anything that my poor, insolvent, drunk, over-leveraged, strung out on meth grandmother would not do, which is very, very little. Join us for Digital Heavyweights. Oh, I get my chance to play my my AI. Hold on. Let me see. Let me see if I can cue it up. This is so much fun. Bum, bum, bum. Do you want to get ahead? We have a program that really dives deep into investment management, game theory, cognitive bias, and the connection between cryptocurrencies, digital assets, and artificial intelligence investing. It's called Digital Heavyweights, and we do 3 private educational streams per week. You also get up-to-date news and research created by a team of writers and analysts that curate data from my personal investment portfolio. We do the heavy lifting for you. Join me and hang out with us Mondays, Wednesdays, and Fridays in the Digital Heavyweights. Now, I know that got a little rednecky at the end. I'm not sure because I don't feel like I sound that rednecky. But you know what? That's not bad. That was on play.ht. That's how I did that. I just took a paragraph. I put it there. I put one of my videos. It scraped the video. And there we go. So anyway, fun times for all. Good luck. Good luck out there.